franchise loans are getting harder to obtain in 2026. Banks are saying no more often, even to brands that used to get approved easily. And if you're thinking about buying a franchise, this matters more than almost anything else. The bank is often the first real test of whether a franchise actually works financially. Today, I'm going to show you how the SBA lending really works, how to think about financing intelligently, and how to look up which franchise loans have defaulted. Most buyers don't even know that this data exists, but it's publicly available, and I'll walk you through exactly how to find it later in the video. I'm Charista Baye from Franchise Inspectors, where we help people find and evaluate good franchises before they invest. So here's what we're seeing in 2026. Banks are getting more cautious. Some franchise brands are being removed from the SBA directory or flagged for additional review. Banks are digging deeper into the Item 19 financial performance claims, and they are stress testing margins. They're looking harder at territory economics, and they're asking for more cash from buyers upfront. We're seeing deals that used to require 15 to 20% down, now needing close to 30% down. And some candidates with solid credit are still getting declined. Why? Well, to understand that, you need to first have an understanding of how the SBA lending actually works. The SBA is the Small Business Administration. It's a U.S. government agency that helps small businesses get financing. They do not lend money directly. Instead, they guarantee a portion of the loan that a bank makes. So if a borrower defaults, the SBA covers part of the loss. That guarantee reduces risk for the bank and makes lenders more willing to finance small businesses, including franchise buyers. But the guarantee does not eliminate risk. It just reduces it. And when defaults rise, banks tighten standards. Because franchising has unique legal structures, the SBA created the Franchise Directory. It started in 2018 to streamline franchise lending. In 2023, it was removed as part of new lending rules. Then last year, it was reinstated with updated certification requirements, and it's updated weekly, and sometimes removals are temporary. The directory is simply a list of franchise brands whose agreements meet the SBA eligibility standards. If a brand is on the directory, lenders can move faster. If it's not listed, lenders may need additional legal review and may decline the loan. But being on the directory does not mean the franchise is a good investment. It only means that it meets the SBA eligibility rules. Now let's talk about what it really takes to qualify for an SBA loan. There are four main areas. First, credit score. Most lenders want to see a personal credit score of at least 680. Some prefer 700 or even higher. Strong credit shows repayment history and financial discipline. Second is cash injection. Typically, you're going to need to invest around 15 to 30% of the total project cost in cash. That's your equity in the deal. In today's tighter environment, we are seeing lenders push that higher and higher depending on the industry risk. The third is post-closing liquidity. Many lenders want you to have additional cash reserves after the deal closes, often around 10% of the total project cost or several months of your personal living expenses. They want to know that you can survive a really slow ramp-up period. And the fourth is collateral. For smaller loans, this may not be required. But for loans above $300,000, lenders may require available collateral such as home equity or other personal assets. And even the loan is partially guaranteed, banks are still looking for ways to secure the remaining risk. Lenders also evaluate your global cash flow. That includes your personal debts, mortgage, car payments, and overall household obligations. They look at your managed experience and industry background. And in many cases, they want to see some kind of stable income during that startup phase. So that might be W-2 income, it could be a spouse's income, or significant liquidity. Now, according to Monitor Daily, the industries with the highest default rate in 2025 were restaurants and food service, hospitality, entertainment venues, retail, and personal services. And not all of these are franchises, but did you know that you can find this exact information on your own? If you go to the SBA.gov, you can go to the datasets area and download the data. It actually goes back to 1991, and you can sort and filter by a lot of different fields. It's a very, very large document, so you may have to spend a couple hours scouring through these. But if you download the fiscal year 2020 to present file, you can sort that one by the loan status and see which loans were charged off and for how much. You can also filter by franchise and look at those in particular. And if you're looking at a specific franchise brand, you can even sort it by that and review a decade of loan data and look at the default patterns of that exact system. Pair that with the item 20 closure trends, and you start to see a full picture of the system health. Now, there are 3 numbers that every franchise buyer needs to understand if you're planning to use a loan. The first is debt service coverage ratio. This measures whether the business makes enough to comfortably pay the loan. If your annual loan payment is $100,000, banks typically want to see at least $125,000 to $150,000 of cash flow. If your model barely clears that threshold, the margin for error is going to be too thin. The second is cash on cash return. This tells you how hard your invested cash is working. If you invested $500,000 and you net $75,000 after everything, that is a 15% cash on cash return. If you net $100,000, that's 20%. On paper, that might sound strong, but if you're working full-time in the business, managing employees, handling operations, and carrying loan risk, you need to ask yourself, is that return worth the time, stress, and capital at risk? Cash on cash return helps you compare franchises, not just based on revenue, but on what you actually walk away with relative to what you have invested. If your goal is semi-passive ownership, that return should look different than if you are planning to operate full-time. And the third is working capital. Working capital keeps you alive during the early months. Most franchise failures are not because the concept never works, they happen because the owner runs out of cash before the business stabilizes. If the FDD estimates 3 months of working capital, you may want to plan for 6 to 9 months instead. Always plan for the worst case scenarios with the hopes of the best case scenarios. So before investing, ask, what percentage of franchisees obtained SBA loans? What is the historical default rate? How many locations closed in the last 3 years? What does the item 20 show about growth versus exits? If a brand avoids these questions, or if you can't find the answers, that tells you something. SBA lending tightening is not just about banks, it's a signal. If lenders are nervous, it's worth asking why. You need to understand the risk before you invest, because liking a brand is not enough. The math has to work. If you want help evaluating a franchise, you can reach us at franinspect.com. And if you're not sure what franchise would be a good fit for you, please reach out. We would love to find some good options for you to explore. And if you found this helpful, please subscribe for more franchise and industry breakdowns just like this.